IRS new penalty, 2026. Senior homeowners must act before the 15th of April. If you own a home and you are over the age of 60, the next few minutes could either save you thousands of dollars or cost you thousands if you walk away without taking action. And I mean that with complete seriousness. This is not a hypothetical. This is not fear mongering. This is a specific, documented IRS enforcement expansion that is actively targeting senior homeowners right now in 2026. And the deadline to protect yourself is firmly set. I have been breaking down IRS policy changes and American tax law on this channel for a long time now. I have covered audits, penalties, enforcement actions, and regulatory shifts that most people never hear about until a letter shows up in their mailbox. But what is unfolding in 2026 is one of the most significant shifts I have ever covered for senior homeowners. Specifically, the IRS has rolled out a new penalty structure quietly, without a press conference, without a headline on the evening news, and it is landing directly on the doorsteps of older Americans who own homes, who have equity, and who had absolutely no idea they were doing anything wrong. The deadline to act is the 15th of April. Not approximately the 15th of April, not sometime before summer. The 15th of April is the hard cutoff, and what happens after that date is out of your hands once it passes. I need you to understand this with clarity. There is a voluntary compliance window open right now. It closes on the 15th of April, and it does not reopen. So stay with me through this entire video. By the time we are done, you are going to understand exactly what this penalty is, exactly who it is targeting, and why, exactly what triggering events are putting you at risk, and exactly what steps you need to take right now today to protect yourself before that deadline hits. And if you are watching this, and you have a parent, a grandparent, an aunt or uncle, a neighbor, anyone over 60 who owns a home, please share this with them today, not tomorrow, today. Because the people who need this information the most are often the last ones to find it. I get messages every single week from people who found one of these videos too late, after the deadline had passed, after the penalty had been assessed, and I cannot tell you how painful those messages are to read. Do not let that be someone you love. Welcome back to USA Visa Explained, where we cut through the complexity of American tax law and government policy and give you the real information you need to protect your money, your home, and your family. No fluff, no hype, just the specifics that matter. Let us start at the foundation, because I want you to understand not just what is happening, but why it is happening, because the why is what makes everything else make sense. For generations, owning a home in America has been treated as one of the most tax-advantaged financial positions a person can be in. You buy a home, you live in it, you build equity over time, and the tax code has traditionally provided significant protections when you eventually sell, transfer, or pass that home on. The capital gains exclusion on the sale of a primary residence allows a married couple to exclude up to $500,000 of gain from taxation. The stepped-up basis rules allow heirs to inherit property at its current fair market value, rather than what the original owner paid decades ago, effectively wiping out decades of capital gains tax liability. The mortgage interest deduction has allowed homeowners to reduce their taxable income by the amount of interest paid on their home loans. That was the foundation of the American homeownership promise. The government wanted you to buy homes. The tax code was designed to reward you for doing so. And for most of the last several decades, that promise held. Millions of seniors built their retirement security on the assumption that their home equity was protected, that the rules were stable, and that the tax advantages they had relied on for decades would continue. But here is what changed. Home values across the United States have appreciated at a pace that nobody, not economists, not real estate analysts, not the IRS, fully anticipated. Homes that were worth $150,000 15 years ago are now worth $400,000 and $500,000 in many parts of the country. Some markets, particularly in the Sun Belt and Mountain West, saw even more dramatic increases. Homes in Phoenix that sold for $200,000 in 2010 are now approaching $600,000. Homes in Boise that were worth $180,000 are now over $500,000. Even in historically stable Midwestern markets, the appreciation has been dramatic by historical standards. And while that increase in value feels like good news, and in many ways it is, it also means that a lot of financial transactions that used to fly under the radar because the dollar amounts were small are now triggering significant tax consequences because the numbers have gotten so large. A senior who took out a $40,000 home equity loan 10 years ago, which seemed modest at the time, might now be sitting on a property worth $500,000. A senior who added their daughter to the deed of a home worth $150,000 in 2010 was transferring $75,000, a value which was below the lifetime gift, tax exemption, threshold, and barely registered on anyone's radar. That same home today, worth $450,000, represents a transfer of $225,000, a transaction that absolutely requires formal IRS documentation. The numbers crossed the threshold where the IRS stopped ignoring them, and the IRS noticed, and in 2026, they acted. What we are specifically talking about is an enforcement expansion targeting what the IRS is calling unreported home equity events. I am going to explain exactly what that means in plain English. But first, I want you to understand the scale of what is happening. The IRS has been building a data infrastructure for the last several years that allows them to cross-reference county property records, mortgage and home equity loan data, deed transfer records, short-term rental income reports from platforms like Airbnb and VRBO, and estate and inheritance filings, all against the actual tax returns that have been filed by American homeowners. They are using artificial intelligence and automated matching systems to identify gaps, and the demographic being flagged most consistently right now is senior homeowners, people over 60, because this group has had more of these triggering events happen in recent years and has been the least likely to know that those events required specific IRS reporting. This was not a random decision by the IRS. It was a strategic, data-driven, targeting decision. Their own internal analysis showed them that the highest concentration of unreported home equity events, by dollar amount, was in the over 60 demographic, not because seniors are doing anything intentionally wrong, but because seniors have had more time to accumulate equity, more time to make property modifications, like deed changes and equity extraction, and less access to professional tax guidance. That keeps up with changing regulations. The IRS saw a gap, quantified it, and built an enforcement campaign around it. So, what are these triggering events? Let me walk you through the most common ones, because there is a very good chance that at least one of these applies to you or someone you know, and I want you to listen carefully to each one, because the specific details matter enormously. The first triggering event is a home equity loan or line of credit used for purposes other than home improvement. Over the last several years, with inflation driving up the cost of everything and credit card interest rates hitting historic highs, millions of seniors turned to their home equity as a source of cash. Maybe you needed to cover medical expenses that Medicare did not fully cover. Maybe you helped a child or grandchild with tuition or a down payment on their first home. Maybe you consolidated high-interest credit card debt into a lower-rate home equity product. Maybe you needed to repair a vehicle or replace an appliance. Those are all completely reasonable financial decisions. In fact, they are often the smartest financial decision available to a senior on a fixed income. But here is what most people were not told at the time, and this is the part that is generating penalties by the thousands. The tax treatment of home equity loan interest depends on how the money was used. Under the Tax Cuts and Jobs Act of 2017, which took effect in 2018, the deductibility of home equity loan interest changed dramatically. If the money was used for something other than buying, building, or substantially improving the home that secures the loan, the interest is not deductible, period. It does not matter that the lender called it a home equity loan. It does not matter that the interest statement you received from the bank shows it as mortgage interest. What matters is what you did with the money. If you took out a home equity line of credit to pay off credit cards and you deducted the interest on your tax return, that deduction was improper. If you took out a home equity loan to pay for your granddaughter's wedding and you claimed that interest as a deduction, that deduction was improper. If you used equity to buy a car, take a vacation, cover living expenses during a period of reduced income, none of that interest is deductible under current law. And if that interest was claimed as a deduction on your tax returns when it should not have been, you have an unreported compliance issue that the IRS is now actively identifying through their data matching systems. The penalty structure for this starts at $500 and scales up based on the amount improperly deducted. For a senior who took out a $50,000 home equity loan at 6% interest, that is $3,000 in annual interest payments. If that was improperly deducted over multiple tax years, we are talking about a significant liability. The second triggering event is a partial property transfer. And this one catches more people off guard than almost anything else I have ever covered. At some point in the last few years, did you add an adult child to your home's deed? Maybe you did it to avoid probate. That is one of the most common reasons. A well-meaning estate planning attorney, or sometimes just a friend who went through probate with their own parents, tells you that adding your children to the deed will allow the home to pass directly to them without going through the probate court process when you pass away. And technically, they are right. Adding someone to a deed does avoid probate for that property. Maybe someone told you it would protect the home from Medicaid estate recovery. This is another extremely common piece of advice, particularly in the context of long-term care planning. The idea is that by transferring the home out of your name, it will not be counted as an asset if you ever need to apply for Medicaid to cover nursing home costs. This is a complex area of law with a 5-year look-back period, and I am not going to go into the Medicaid planning implications here. But the point is that many seniors made these transfers based on advice they received about Medicaid protection. Maybe you just wanted to make sure your family would not have to go through a complicated legal process when you are gone. You wanted to simplify things for your children. You were trying to be helpful. All of those motivations make complete sense. They come from a place of love and responsibility. But here is what most people did not know when they made that deed change. Adding someone to a property deed is treated by the IRS as a gift of real estate, and gifts of real estate above the annual gift tax exclusion, which is $18,000 per recipient for 2026, require the filing of Form 709, the gift tax return. If your home is worth $400,000 and you gave your child a 50% interest, you transferred $200,000 of value. Form 709 should have been filed that year. If it was not, you now have an unreported gift event on record, and the IRS's property record matching systems are finding these by the thousands. The third triggering event is rental income from your primary residence. This has become increasingly common among seniors, and I understand why it happens. You have a spare bedroom now that the kids have moved out. You have a finished basement that sits empty most of the year. Maybe you have a detached garage apartment or an in-law suite. The house feels too big for just you or you and your spouse, but you do not want to sell. This is your home. You raised your family here. You know your neighbors. Selling feels like losing a part of your life. Platforms like Airbnb and VRBO make it easy to rent out a room or a whole floor for extra income. You take some photos, write a description, set a price, and within days you have bookings, and that extra income can make a meaningful difference in a fixed income household. An extra $500 or $1,000 a month can cover prescription costs, property taxes, home maintenance, or just give you breathing room in the monthly budget. But the moment you start receiving rental income from your primary residence, you have converted part of your home from personal use to income-producing use in the eyes of the IRS. That triggers a whole set of reporting requirements that most casual landlords are completely unaware of. You need to report the income on Schedule E of your tax return. You need to properly allocate expenses between personal use and rental use. This is not as simple as just reporting the gross income. You need to determine what percentage of your home is used for rental purposes, typically based on square footage, and then allocate a corresponding percentage of your mortgage interest, property taxes, utilities, insurance, maintenance, and depreciation. You need to account for depreciation on the rental portion of the home. This is where it gets particularly complicated, and it is the part that almost nobody who casually rents out a spare bedroom thinks about. When you depreciate the rental portion of your home, you are reducing your cost basis in the property. That reduced basis will increase your taxable gain when you eventually sell the home. And because depreciation recapture is taxed at a higher rate than capital gains, this can create a surprisingly large tax bill at closing. Airbnb and VRBO are now legally required to report annual payments above $600 directly to the IRS with a 1099. So, if you have been renting out part of your home and not reporting that income, the IRS already has the 1099-K data showing exactly how much you were paid. They are not guessing. They are not estimating. They have a document from the platform that processed your payments. They are just waiting for the matching process to complete. And when it does, if that income does not appear on your return, the automated system flags it. The fourth triggering event is the inherited property trap. This one is particularly painful because it involves people who were already going through grief and loss when it happened. If you inherited a property, a spouse's share of your home, a vacation cabin from a sibling, a piece of land from a parent, in the last several years, there are specific documentation requirements that govern how the value of that property is established at the time of inheritance. This is what the tax code calls the stepped-up basis. When you inherit property, your basis for future tax purposes is generally the fair market value of the property at the date of death, not what the original owner paid for it decades ago. So if your parents bought their home for $35,000 in 1972, and it was worth $350,000 when the second parent passed away in 2022, your basis in that home is $350,000, not $35,000. If you sell it for $375,000, you only owe capital gains tax on $25,000, not on $340,000. That stepped-up basis is one of the most valuable provisions in the entire tax code for inheritors. It can save inheritors tens or even hundreds of thousands of dollars in capital gains taxes, but it only works if it is properly documented. If the estate did not file the appropriate forms establishing the fair market value at the time of inheritance, you may be holding a property with an undocumented basis. The IRS takes the position that the basis is zero if it cannot be documented, which means the entire sale price is treated as taxable gain. That is the worst-case scenario, and it happens more often than you would think. Under the 2026 enforcement expansion, the IRS is now flagging these basis documentation failures and issuing penalties for the failure to establish and report proper basis records. Now, I want to pause and address the question that I know is on a lot of people's minds right now. How would the IRS even know about any of this? How could they possibly know that you added your son to your deed in 2019? Or that you rented out your basement on Airbnb for 6 months in 2023, or that you took out a home equity loan and used it for something other than home improvement? The answer to that question is what makes 2026 genuinely different from everything that came before. For most of tax history, the IRS caught compliance issues through audits, a relatively labor-intensive process where agents manually reviewed returns and cross-referenced records. An auditor would have to pull your return, notice something that looked unusual, request supporting documentation, compare it against third-party records that they had to request individually from counties and financial institutions, and then make a determination. This process was slow, it was expensive, it was limited in scale. Audit rates for individual taxpayers fell to historic lows, well below 1% for most income brackets. Enforcement was uneven, and a lot of unreported home equity events simply slipped through because the IRS did not have the resources to find them. That era is over. The IRS now has automated data sharing agreements with county recorder offices in the majority of states, which means every deed transfer, every title change, every recorded lien is flowing into their systems in near real time. They have agreements with mortgage servicers and home equity lenders who report loan originations and account activity. They receive 1099-K data from short-term rental platforms. They receive estate and inheritance filings, and they have built machine learning systems that compare all of this incoming data against filed tax returns, looking for gaps, mismatches, and omissions at a scale and speed that was simply not possible 5 years ago. By the time you receive a penalty notice in your mailbox, the IRS's system has already done the analysis. It has already matched the county recorder's deed transfer data against your filed gift tax returns and found that Form 709 is missing. It has already compared the 1099-K from Airbnb against your tax return and found that Schedule E is absent. It has already cross-referenced the mortgage servicer's report of your home equity loan origination against the interest deduction you claimed and flagged the mismatch. The letter is not the beginning of their investigation. It is the conclusion, and that means you need to be proactive, because waiting to see if you get a letter is a losing strategy in the current environment. And that brings us to the 15th of April, and why that specific date matters so much. Right now, the IRS has a current policy in effect for 2026, specifically for this enforcement expansion. That includes a voluntary compliance window for senior homeowners. If you identify issues with your past reporting and come into compliance before the 15th of April, you are eligible for first-time, penalty, abatement consideration, and good faith compliance credit. In plain, English. That means if you voluntarily fix your mistakes before the deadline, the IRS has the discretion to significantly reduce, or in some cases eliminate the penalties associated with those mistakes. This is a meaningful concession, and it is time-limited. After the 15th of April, the voluntary compliance window closes. Penalties that were not resolved become final assessments, and your options for disputing or reducing them become much more limited and much more expensive. The difference between resolving this before the 15th of April and after the 15th of April can easily be thousands of dollars in penalties. So, let me tell you specifically what you need to do, and I want to be genuinely useful here, not vague. Here are the concrete steps. Step 1 is to gather your home-related financial documents, going back to 2022. I want to be specific about what you are looking for. You need your original purchase documents, your closing disclosure, or HUD-1 settlement statement, which shows what you originally paid for the home and what costs were included. You need records of any major improvements you made to the property over the years. A new roof, a kitchen remodel, an added bathroom, a finished basement. These all increase your cost basis in the home, which reduces your taxable gain when you eventually sell. A lot of seniors have made significant improvements over the years, but have never kept records of them, and that is costing them money because they cannot prove the higher basis. You need any home equity loan or HELOC statements, including the loan agreement that shows what the stated purpose of the loan was, and any bank statements that show what the money was actually used for. If you can document that the money went to a contractor who renovated your kitchen, that is a different situation than if the money went to pay off credit card balances. The paper trail matters. You need any deed or title documents showing transfers or changes in ownership in the last 4 years. If you added someone to your deed, find the document that recorded that change with the county. If you transferred the property into a trust, find the trust documents and the deed reflecting the transfer. And if you have been renting out any portion of your home, you need records of the income you received and the expenses you incurred, advertising costs, cleaning fees, supplies, and any repairs specific to the rental space. You also need to determine what portion of your home was rented, typically calculated as the square footage of the rented space, divided by the total square footage of the home. Step 2 is to do a simple side-by-side comparison of those documents against your last 3 tax returns. You do not need to be a tax expert to do this. You are just looking for obvious mismatches. Did you take out a HELOC, but there is nothing on your return addressing the interest deductibility? Did you add someone to your deed, but there is no Form 709 in your records or mentioned on your return? Did you receive rental income, but there is no Schedule E on your return? Are there deed transfers showing up in the property records that were not accompanied by any kind of tax filing? You are just inventorying the gaps at this stage, making a list, identifying what may need to be addressed. Step 3 is to take that inventory to a tax professional. And I want to be specific about what kind of tax professional you want. A certified public accountant or an enrolled agent. An enrolled agent is someone who has passed a rigorous IRS examination and is specifically authorized to represent taxpayers before the IRS. You want someone who has experience in real estate taxation, not a general preparer, not the person who has been filing your basic return for years at a strip mall tax office. Someone who specifically understands home equity taxation, property transfers, gift tax rules, and IRS penalty abatement procedures. If you do not know how to find one, the National Association of Enrolled Agents has a directory on their website where you can search by location and specialty. The American Institute of CPAs has a similar resource, and when you call, ask specifically whether they have experience with IRS penalty abatement for real estate-related issues. That question alone will tell you quickly whether they are the right person for the job. If they hesitate or give you a vague answer, call someone else. Step 4 is to check your IRS account transcript online. Every American taxpayer can create a free account at irs.gov and access their official tax transcripts. You can see what returns have been processed, what notices or assessments are already on file for your account, and what third-party data, including 1099s, W-2s, and property-related reports the IRS has received and matched to your Social Security number. This is an incredibly powerful tool, and most people have no idea it exists. Setting up an account takes about 15 minutes. You will need to verify your identity using information from your credit file, so have a copy of your most recent tax return and a mobile phone in your name available. Once you are in, Your transcript will show you exactly where you stand. If there are already pending notices or assessments related to your home, you will see them there. If the IRS has received 1099-K data from a rental platform that you did not report, you will see that on your wage and income transcript. Knowledge is everything when it comes to the IRS, and this tool gives you knowledge directly from the source. Step 5, and this is critically important, is to respond to any IRS notices you have already received. If you have gotten a letter in the last several months that you set aside or did not fully understand, pick it up right now. Look at the notice number in the upper right corner. Common notices related to these home equity and property issues include CP 2000, which is an automated underreporter notice generated when the IRS's systems find income that was reported to them by a third party, but not reported on your return, and CP 75, which is a document request related to items on your return. Every IRS notice has a response deadline printed on it. That deadline is not a suggestion. If that deadline has passed, that does not mean the issue is resolved. It does not go away because you ignored it. What it means is the IRS has likely escalated the matter. Contact a tax professional immediately if you have any outstanding IRS notices that have not been properly responded to. Do not wait. Do not hope it resolves itself. Do not assume it was a mistake. Every day that passes after that response deadline makes the situation harder and more expensive to fix. Now, I want to spend a moment talking about the specific forms that are relevant to these issues, because knowing what forms are involved will make your conversations with professionals much more efficient and will help you understand what you are actually dealing with. Form 709 is the gift and generation skipping transfer tax return. This is what you file when you give someone a gift that exceeds the annual exclusion, and transferring a partial interest in real estate absolutely counts as a gift. A lot of people think the gift tax only applies to cash. It does not. Real estate, stock, business interests, and other assets all count. If you added a family member to your deed and the value transferred exceeded $18,000, which it almost certainly did if your home has appreciated at all since you bought it, Form 709 should have been filed for that year. The failure to file penalty for Form 709 is typically a percentage of the gift tax that would have been owed. And while most people will not actually owe gift tax because of the lifetime exemption, the failure to file can still trigger penalties. Schedule E is supplemental income and loss. This is the form where rental income and expenses from residential property are reported. If you have been renting out any part of your home and there is no Schedule E on your returns, that is one of the most common flags the IRS's matching systems are currently identifying. You will need to report both the income and the allowable expenses, including depreciation, which many casual landlords completely overlook. Form 8949 and Schedule D are the capital gains reporting forms. These are used when you sell a property or a partial interest in a property. Errors here typically involve incorrectly calculating basis, paying too much in taxes because you did not properly account for the cost of improvements you made over the years, or triggering penalties because the gain was misreported or underreported. And for inherited property, the relevant document is typically the estate tax return, Form 706, which should have been filed by the estate at the time of inheritance, and which establishes the stepped-up basis for all inherited assets. If you inherited property and no Form 706 was filed, or if the form was filed but did not properly value the inherited property, perhaps using an outdated appraisal or no appraisal at all, you may have a basis documentation problem that needs to be corrected with the help of a professional. I also want to address the emotional reality of this situation for a moment, because I think it is important, and most financial content ignores it completely. Many of the seniors who are caught up in this enforcement expansion are people who did not do anything intentionally wrong. They made decisions about their homes, adding a child to the deed, renting out a room, taking out equity for medical bills. That felt completely normal and reasonable at the time. Nobody sat them down and said, by the way, this specific action requires this specific IRS form that you have never heard of. Nobody explained that the tax treatment of home equity loan interest changed in 2018. Nobody told them that renting out a spare bedroom on Airbnb meant they had just become a small business in the eyes of the IRS, with all the reporting obligations that entails. These are not tax cheats. These are not people looking for loopholes or trying to hide income. These are seniors who were trying to manage their finances responsibly and got caught in a regulatory shift that nobody warned them about, and now they are facing penalties for things they did not know were violations. That is genuinely unfair. I want to say that clearly it is unfair, but fairness is not a defense with the IRS. What matters is compliance, and the system we are dealing with does not adjust itself based on intent or ignorance. What it does respond to is proactive action, documented good faith, voluntary disclosure before deadlines. Those things do move the needle with the IRS. They do influence how penalties are assessed and whether abatement is granted. So while the situation may feel unfair, and it is, the path forward is not to argue about fairness. It is to take the steps that give you the best possible outcome within the system as it actually operates. The IRS is not going to say, "Oh, you did not know. Never mind." They are going to say, "You did not know, but now we have informed you, and here is what you owe." Your best defense is to get ahead of it, document your good faith effort to comply, and work with a professional who knows how to navigate the penalty abatement process. I also want to take a moment to address scammers, because I would be doing you a disservice if I did not. Anytime there is a high-profile IRS issue, especially one affecting seniors, the scammers come out in force. They know that seniors are worried. They know that the word IRS creates fear, and they exploit that fear ruthlessly. You are going to get phone calls from people claiming to be IRS agents who say you owe money immediately and will be arrested if you do not pay by wire transfer or gift card within the next 2 hours. You are going to see ads for companies that promise to make all your IRS problems disappear for a flat upfront fee, companies that have no CPAs or enrolled agents on staff, just salespeople who collect your money and disappear. You are going to get emails with IRS logos claiming to be official notices requiring immediate action. Emails that link to fake websites designed to steal your personal information. None of that is the real IRS. The real IRS communicates through official postal mail. The real IRS does not call you demanding immediate payment. The real IRS does not accept gift cards or wire transfers as payment. The real IRS does not threaten arrest over the phone. The real IRS does not send unsolicited emails demanding personal information. If anyone contacts you claiming to be from the IRS and creates urgency around immediate payment or personal information, hang up, delete the email. And if you want to be thorough, report it to the IRS phishing line at phishing@irs.gov. The real process of resolving IRS issues takes time, involves paperwork, and is handled through official channels. That is exactly why having a legitimate professional on your side matters so much. A real tax professional will never demand immediate payment over the phone, will never threaten you with arrest, and will always provide their credentials and give you time to verify them. I also want to address one more scenario that affects a specific group of seniors watching this. Those who are in the process of planning their estate or thinking about how to pass their home to their children or grandchildren, because the 2026 enforcement environment has significant implications for estate planning strategies that involve real estate. If you are planning to simply add your children to your deed as a way of transferring the home outside of probate, you need to know that this strategy, while common, has significant tax consequences under current law that many estate planning guides written even a few years ago did not fully account for. Depending on when and how the transfer happens, your children may lose the stepped-up basis benefit they would have received if they inherited the property at your death, rather than receiving it as a gift during your lifetime. That could cost them significantly in capital gains taxes if they ever sell the home. The loss of the stepped-up basis on a home that is appreciated by hundreds of thousands of dollars over decades of ownership can result in a capital gains tax bill that is 6 figures or more. That is money your children lose because of a deed transfer that was intended to help them. There are alternative estate planning strategies that can accomplish the goal of avoiding probate without sacrificing the stepped-up basis. Revocable living trusts, transfer on death deeds where available under state law, and properly structured life estates can all achieve probate avoidance while preserving the tax advantages of inheritance. But these strategies require proper legal documentation and should be implemented with the guidance of an estate planning attorney who understands both the state law implications and the federal tax consequences. This is a complex area of law, and the right approach depends on your specific situation, your state's laws, and your family's plans for the property. But if you have already made partial deed transfers or are planning to, this needs to be part of the conversation with your tax professional or estate planning attorney. Do not assume that what worked for your neighbor or what you read in an estate planning guide from 2015 still applies. The rules have changed, and the enforcement environment has intensified. Now, let me talk briefly about what happens after the 15th of April, because I want you to understand what you are actually racing against. After the voluntary compliance window closes, the IRS's standard penalty and enforcement procedures take over fully. Penalties that were potentially abatable before the deadline become final assessments. The IRS's discretion to waive or reduce penalties narrows considerably. Your options for disputing the assessment become more limited, more procedural, and more expensive. If you owe back taxes in addition to penalties because rental income was unreported, for example, or because a HELOC deduction was improper and resulted in an underpayment of tax, interest continues to accrue on the unpaid balance. The IRS interest rate is adjusted quarterly and compounds daily. What starts as a manageable amount can grow significantly over time. The IRS can place liens on property to secure unpaid tax debts. A federal tax lien attaches to all of your property, including real estate, and to all of your rights to property. It is a public document that appears on your credit report and in the public records of your county. And while outright seizure of a primary residence is relatively rare and involves multiple layers of legal process and judicial approval, a tax lien on your home can complicate any future sale, refinancing, or transfer of the property significantly. A title company will require the lien to be satisfied before they will issue title insurance, which means before you can sell or refinance, the IRS must be paid. None of those outcomes are inevitable. If you act now, every single one of them becomes more likely and more expensive if you wait. The voluntary compliance window exists specifically because the IRS knows that many of these violations are the result of honest mistakes and changing rules. They are giving you an opportunity to come into compliance on your own terms. That opportunity has an expiration date. So, let me give you the complete summary of what we covered today. The IRS has expanded enforcement in 2026, specifically targeting senior homeowners for unreported home equity events. This is not a rumor or speculation. It is an active enforcement campaign backed by automated data matching systems that cross-reference county property records, mortgage data, rental platform reports, and tax returns. The four most common triggering events are home equity loans used for non-home improvement purposes, where the interest was improperly deducted, partial property transfers like adding family members to a deed without filing the required gift tax return, rental income from a primary residence that was received but not reported on Schedule E, and inherited property with undocumented basis that prevents the inheritor from claiming the stepped-up basis they are entitled to. The IRS now has powerful automated data matching capabilities that mean they can identify these issues without traditional audits. They are not guessing. They have the data. The question is not whether they can find the issue. The question is whether you address it before they send you a letter. A voluntary compliance window with penalty abatement provisions is available for senior homeowners who come into compliance before the 15th of April. This is a real, documented IRS policy, and it has an expiration date. The steps you need to take are clear. Gather all home-related financial documents from the last 4 years. Do a simple comparison against your recent tax returns to identify gaps. Consult a CPA or enrolled agent with real estate tax expertise. Check your IRS account transcript at irs.gov. And respond immediately to any outstanding IRS notices you have already received. The key forms to know are Form 709 for gift transfers of real estate, Schedule E for rental income, Form 8949, and Schedule D for capital gains, and Form 706 for inherited property basis documentation. Do not try to handle this alone. Do not wait to see if a letter shows up. Do not fall for scammers who claim to be from the IRS and demand immediate payment. And do not miss the 15th of April. You now have everything you need to take the right steps. Most senior homeowners who end up paying unnecessary penalties will do so not because they could not have fixed the situation, but because they did not know about it in time or did not act when they found out. You are not in that position anymore. You found out. Now act.